Welcome into an acquired taste. Today, I want to talk a little bit about venture capital and the state of venture capital fundraising for startups. There's a lot of discussion about this, but I think that we have enough data and enough time has passed where we can actually look at this a little bit more completely. And I want to try to take some time to explain this in the simplest terms possible, because I think that we can get in the weeds in this stuff, and I don't think that's really helpful. So let me just jump right into it. So let's start with kind of a broader perspective. So yes, the amount of venture capital being deployed right now is significantly lower than in the past, but I'm going to put an asterisk on that to define the past in just a second, because I think that context is important. Liquidity for investors is historically low. And what I mean by that is that investors are placing investments in startups, and then they're having to wait a really long time to get any of that return of capital. And so if that happens, they can't cash out. If they can't cash out, then that creates illiquidity. And we'll talk a little bit about the ramifications for that in a second. There are a lot of funds and a lot of investors out there that will not re-raise or will not reinvest, and they'll probably go away. That's not just small and kind of unremarkable or also ran type funds. These are well-known funds. We've had a few that have announced or have followed through with plans that were previously announced where they weren't going to re-raise, and that's happened. And when that happens, then obviously capital kind of goes away within that available funding pool. And you know, it is. I don't know how else to put it. It's just taking longer for startups to raise capital. There isn't as much out there. It takes longer to do. The terms are less favorable. So yeah, that is all happening. But I think there's a couple things we want to talk about. VC investments are not in the tank. They're not terribly low when you consider the number of deals or the total capital being deployed and looking at the last 10 years of venture activity. Activity is down compared to 21 and 22, 2021, 2022. But those were also historically the highest levels for total deal value, total deal count ever recorded by kind of the national industry standard for reporting, which is the National Venture Capital Association. By the way, I recommend, if you want to nerd out on any of these numbers, download their Venture Monitor report. They put one out every quarter. It's phenomenally good and detailed. And that activity is down, but I think it's important to understand that for deal count and for deal value in 2023, it just looks more like 2019 and 2020. And if you think about the decade leading up to 2019 and 2020, those are pretty good decades, or that was a pretty good decade for venture and for startups and for venture investing. So this is a little bit more of a reset. But yes, if you compare it to 21 and 22 or 20 and 21, it's not great compared to those things. But those were arguably artificially high. So why is that happening? So again, I'm going to try to make this as simple as possible. I'm not an economist. Don't pretend to be an economist. I also don't want to get into some weird esoteric or, obscure argument about this thing that happened, butterfly effect, 50,000 miles away, and now this is the ramifications. I don't think it's that complicated. I think there's some basic things. And this isn't comprehensive, but let's just go through kind of the big pieces. So a lot of things kind of happened over a very short period of time that kind of culminated in this pullback, for lack of a better term, in venture capital investing. So first, a lot of startups raised a lot of money on really high valuations, and those startups either ran a bad business model with poor assumptions that weren't able to re-raise, or frankly speaking, had bad actors or fraudulent CEOs. I think if you look at FTX as a good example, there was a lot of investment dollars that went into that company, and turns out that it was mostly fraudulent, or certainly most aspects of that company were fraudulent. And while that's not abnormal in venture, you did see a concentration around fewer deals. So a lot of money going into fewer deals. If any of those deals didn't work out, the math starts to suffer pretty badly across the asset class or across the industry. There are fewer IPOs and M&A activity. And this kind of goes back to the point of illiquidity for those venture investors. If venture investors have to sit on an investment indefinitely and they're not getting that capital returned through stocks that are part of an IPO that are issued to that investor, or somebody's not coming and buying that company, then that lack of liquidity certainly means that there's going to be less opportunity and less interest in taking that capital and reinvesting it. The other part of it is the handful of IPOs, at least around tech stocks or tech companies, or at least high-profile startups that happened, are now what are referred to as broken IPOs, which means that they are currently trading their per share price is lower than what their initial public offering price was. Obviously, that's not hard to understand that if you were awarded shares as an investor in an early stage startup as part of that IPO, that presumably had a lockup period of some period of time, or even if they didn't, they immediately started becoming less valuable, then you potentially lost value, or you may have even lost really your investment to a large degree. Some of these are down like 90%. So if you don't have IPOs that are successful, and then you also have this liquidity issue, easy to see why investors aren't exactly lining back up to reinvest. The other part of it is the stock market. It's booming. I mean, it's doing well, setting records, returning. I saw an interesting statistic that I'm probably going to butcher right now, but there's basically 7 stocks right now that are so valuable, or 7 companies that are so valuable on the stock exchange that they represent more than the value of like the G2 through G8 company or countries total economies, like total market size combined. So there are these mega companies that are just getting that much bigger. And so if you're in one of those, 7 stocks, you've probably done pretty well. Increased interest rates just makes it that much harder to borrow money, or at least justify borrowing money. There's a hangover effect from the zero interest rate period that preceded what is, I think, arguably a pretty modest increase in interest rates, but they feel massive compared to zero. I mean, anything above zero is going to feel significant. So that has a dual effect. One is that money is not as cheap, so it is more expensive to borrow, so then it is therefore more scarce in deployment. The other part of it is if you do have cash, it's now worth something. So you can invest in a booming stock market that has significantly less risk than startup investment. You could sit on your cash in a high interest bearing account, whether even savings account or money market account, and reasonably make 3.5%, 5.5% annually right now. That's pretty compelling, especially when it's looked at in terms of the total risk. So what does this mean for startups that are trying to get funding? Funding's tight. There's no other way to look at it. I'm not going to pretend to know where it's going from here, but you're not going to see the valuations or the deal terms that you saw in 2020, 2021, maybe even 2022. Do they have to be terrible terms? No, but this is a little bit of a reset, and I think that there are investors out there that have felt a little bit like they've been overpaying, that they've been paying on high valuations, that they've been giving deal terms away that are so founder friendly in a way to try and compete for that investment and against other investors. So I do think there are investors that are certainly enjoying paying what they think is probably closer to what the market should represent as far as valuations in these private companies. The best companies will still get funding. It's going to be slower. It may be harder. It may be less. Terms may not be quite as good. I think the funding's still out there. We still see tons of, companies getting funded, and to really see that change and really shift as far as time wise and amounts and valuations and things like that, the money that's sitting on the sidelines, kind of the nervous money, for lack of a better term, is just going to have to come off the sidelines. It may take some time. And then the consolidation of investment around fewer and bigger deals. So the National Venture Capital Association published an interesting statistic in their Q4 summary report from 2003, and they said that 10% of the total deal value of all venture capital investing in 2023 went to 2 deals, and they were both in AI. And that, to me, was really shocking for a couple of reasons. That consolidation, but also just a demonstration of the frothiness around AI. And when that happens around a market segment, or when that starts to happen around consolidating against just fewer and fewer deals, it's harder for smaller or non-AI startups to get attention within those, that group of investors. So the biggest question is when will this all change? And I'm not going to try and predict something just to be wrong. But I would assume this isn't a blip. This feels to me more like a reset of the market. So this feels like a return to kind of maybe cooler heads, more reasonable terms, more reasonable valuations. And that's going to have a cascading effect for startup founders. So capital efficiency is in vogue. Getting the most out of your investment dollars, extending your runway, showing a path to profitability, solid unit economics. These are things that were not foreign concepts that long ago in venture investing, and they kind of fell out of favor during the days of blitz scaling and kind of FOMO and frothy markets and all the things that ran 2021, 2022, 2020 kind of up and to the right as far as deal value, as far as valuations go. So this is a bit of a reset. So you have to be thinking about those things. If you are a startup and you're trying to raise, you're going to have to think about those kinds of things as far as how do you want to run your business and what expectations are investors going to have if they're going to be serious about looking at you. So hope that was helpful. Again, not comprehensive. Love to hear your comments. Tell me what you think. Tell me what I got wrong. Look forward to it. And thanks for checking it out.